Before you learn a single ICT concept, before order blocks, before fair value gaps, before kill zones, you need to understand one thing first: market structure. Because without market structure, you have no direction. And without direction, every other ICT concept is just a random setup with no context behind it. In this video, I am going to show you exactly how ICT reads market structure, what higher highs, higher lows, lower highs, and lower lows actually mean in the context of smart money, and more importantly, how you use it to establish your bias before you even think about entering a trade. This is the foundation. Everything we build in this series sits on top of what I'm about to show you. Let's go. Welcome back. Episode 2 of the ICT Concepts Master Series. If you missed episode 1 where we covered what ICT actually is and the smart money concept, go watch that first. Link is in the description. It gives you the context for everything we do here. Today, market structure. Let's get on the chart. Market structure is simply the way price moves. It moves in waves. It pushes up, it pulls back, it pushes up again, or it pushes down, pulls back up slightly, then pushes down further. Those waves create a sequence of highs and lows. And that sequence tells you everything about who is in control of the market, the buyers or the sellers. When price is in an uptrend and when buyers are in control, you will see a specific pattern. Each push-up reaches a higher point than the previous push-up, and each pullback stops at a higher point than the previous pullback. In ICT, we call those higher highs and higher lows, HH and HL. The opposite is true when sellers are in control. Each push down reaches a lower point than the last. Each pullback stalls lower than the last. Lower highs and lower lows, LH and LL. This is not complicated. In fact, you might be thinking, I already knew this. But here is where ICT takes it further than what you have seen before. In traditional technical analysis, most traders draw horizontal support and resistance lines and look at general trend direction. ICT is more precise than that. The first thing ICT focuses on is swing points. A swing high is a candle that has a lower high on both its left and its right. A swing low is a candle that has a higher low on both its left and its right. These are your reference points. They are the highs and lows that matter. Now here is the important part. In ICT, market structure is not just about identifying the trend. It is about identifying which swing points price must break and which ones it is drawing toward. When price is making higher highs and higher lows, you have a bullish market structure. That means your bias is to look for buys. You do not short into a bullish structure without a very strong reason. Smart money is positioned long. You want to be positioned the same way. When price is making lower highs and lower lows, your bias flips. Bearish structure. You look for sells. Full stop. Now, the most important question you need to be asking every single morning before you touch a trade is this: what is the current market structure on my higher time frame? Daily. 4-hour. Weekly, if you are swing trading. That answer, bullish or bearish, becomes your bias for the entire session. You only look for trade setups that align with it. That is how ICT traders avoid the common mistake of shorting into a bullish trend and wondering why they keep losing. Now here's where it gets really important. And this is the part that most beginners miss. Market structure does not stay bullish or bearish forever. It shifts. And knowing when a shift is happening is one of the most valuable things you can learn in ICT. When price is in a bullish structure, higher highs and higher lows, and then breaks below a significant swing low, that is a structural break. That is price telling you that the buyers may no longer be in control. In ICT language, this is called a break of structure, or BOS, when the break continues the existing trend. Or it can be the beginning of a change of character, CHoCH, when it signals a potential reversal. We are going to cover BOS and CHoCH in full detail in episode 3, but I want you to understand right now that market structure is a living thing. It is not one label you put on a chart and forget. You are constantly updating it as price creates new swing highs and lows. Here's a practical rule that will serve you well. If price is in a bullish structure on the daily, look for buys on the lower time frame. If price breaks the daily structure bearish, stop looking for buys. Wait for confirmation of the new structure before you trade. Simple. But most traders never do this because they are too focused on the lower time frame setups and completely ignoring the higher time frame context. If you're serious about trading, you need more than just knowledge. You need the right tools. At the dtctools.com, we've built 3 professional-grade strategies: CCT, DTC, and DTC Precision Pro, each with its own TradingView indicator, MT5 automated bot, and live signals group. Whether you're passing a prop firm challenge, managing a funded account, or trading your own capital, we have a system built specifically for your goal. No guesswork, no emotions, just systematic, rule-based trading, engineered for consistency. Follow us on Telegram, link is in the description, and use code TELEGRAM20 at checkout for 20% off your next order. Visit thedtctools.com and find the tool that fits your trading journey. One of the most powerful things about reading market structure the ICT way is that you can apply it across every single time frame, and the higher time frames always take priority. Think of it in layers. The weekly chart gives you the macro structure, the big picture bias. The daily chart refines it. The 4-hour confirms the intermediate trend. The 1-hour and 15-minute charts are where you find your actual entry. If the weekly is bullish, the daily is bullish, and the 4-hour pulls back to a key level. That pullback is an opportunity, not a reason to panic. Every lower time frame dip inside a higher time frame bullish structure is a potential buy setup for ICT traders. This concept of top-down analysis is something we will build on throughout this entire series. But it all starts right here, with knowing what the structure is on every time frame before you do anything else. So let's recap. Market structure is the sequence of swing highs and lows that price creates as it moves. Higher highs and higher lows equals bullish structure. You look for buys. Lower highs and lower lows equals bearish structure. You look for sells. Structure can break and shift. When it does, your bias shifts with it. And higher time frame structure always takes priority over lower time frame noise. That is the foundation. Everything in this series, every entry model, every concept we cover, assumes you can read market structure first. Make sure this one clicks before you move on. In episode 3, we are going deeper into what happens when structure breaks, the difference between a break of structure and a change of character, and exactly how ICT uses those moments to time entries. That is one of the most important distinctions in all of ICT. Do not miss it. If this was helpful, leave a like. It genuinely helps this series reach more traders. Drop a comment with one question about market structure and I will answer every single one. Subscribe, and I will see you in episode 3.